Hello. The IASB has published an exposure draft of proposals for targeted improvements to IAS 37, the provisions standard. The aim is to make IAS 37 easier to understand and apply, and to give users of financial statements earlier and better information about a company's provisions. I'm Joan Brown, and joining me is Stefano Tampubolon.
We're the IASB technical staff who have been working on these proposals, and we're here to introduce them to you.
The proposals are published in the exposure draft Provisions Targeted Improvements, and that exposure draft has 3 sections.
The first section shows the proposed amendments to IAS 37. The second has proposals for enhancing the implementation guidance accompanying IAS 37. And the third contains the basis for conclusions, which explains the reasoning for the proposals.
You can download all sections from the IASB website and submit your comments online.
Let's start by considering what the amendments to IAS 37 aim to achieve. There are 3 sets of amendments. They are unrelated and have different aims.
So the first set of amendments aim to achieve clearer requirements on when to recognise a provision, and they would lead to earlier recognition of some provisions, most notably provisions for some levies. The existing requirements in this area are a little bit muddled, and so they're a continuing source of confusion and questions to the IFRS Interpretations Committee. Clearer requirements would reduce the time that preparers of financial statements spend working out how to comply with IAS 37, so their compliance costs would be lower. And clearer requirements are also likely to mean that companies apply IAS 37 more consistently. Earlier recognition of some provisions would provide users of financial statements with earlier information about how an entity's present obligations will affect its future cash flows.
The second set of amendments would affect the measurement of long-term provisions. They would tighten the requirements relating to the rates that companies use to discount the future expenditure required to settle the provision to its present value. The aim is to improve the comparability of the measures by standardizing the discount rates entities use and by increasing the transparency of those rates through disclosure.
And then finally, the third amendment would add an explicit requirement on which costs to include in the measure of a provision. This is a relatively minor amendment to clarify a requirement that many people already think is implicit in IAS 37, so we don't expect it to have much effect in practice, other than to avoid unnecessary questions and so reduce compliance costs for preparers of financial statements.
I'll now outline how the amendments would achieve those aims, starting with the clearer requirements on when to recognize a provision. This would be achieved by disentangling the requirements supporting one of the criteria for recognizing a provision, the present obligation recognition criterion, aligning the requirements with concepts the IASB added to its conceptual framework in 2018. This involves removing the current definition of an obligating event and replacing it with requirements to meet 3 separate conditions currently embedded in that definition. The first condition requires a mechanism to be in place, for example, a law or a contract that imposes on the entity a responsibility it will have no practical ability to avoid if it obtains specific benefits or takes a specified action. The second condition is that the nature of the responsibility is to transfer an economic resource. And the third condition is that the obligation is a present obligation that arises from a past event. The entity has obtained the benefits or taken the action referred to in the obligation condition.
Further amendments are proposed to support the new requirements. These include adding to IAS 37 application requirements for threshold-triggered costs. That is, costs that are triggered if a measure of an entity's activity in a period exceeds a threshold. An example would be a levy payable only by entities whose annual revenue exceeds a specified amount. The proposal is to specify that the past event condition is met, and so a present obligation accumulates as the entity's activity proceeds towards the threshold and after it crosses the threshold. The entity accrues a provision as the activity progresses if the other recognition criteria are met at that time. That is, if it's probable that the entity's activity will exceed the threshold, so a cost will be incurred, and if a reliable estimate can be made of the amount of the cost attributable to activity to date.
The exposure draft also includes proposals to enhance the implementation guidance accompanying IAS 37. Firstly, by expanding the analysis supporting each of the existing illustrative examples, explaining for each example whether the three new conditions for a present obligation are met and why or why not. And secondly, by adding new illustrative examples, including examples of various levies and fact patterns submitted to the IFRS Interpretations Committee for clarification. People who've already given us feedback on the exposure draft have told us that the expanded analysis in the illustrative examples has helped them understand the proposed amendments to the standard. So I do recommend that you look at these examples and not just the amendments to the standard itself.
Now, as I said at the start, the proposed amendments would not only clarify the present obligation recognition criterion, they would also lead to earlier recognition of some provisions. This is because they would change the past event condition. The exposure draft proposes to remove the current requirement, which is that the obligation must exist independently of the entity's future actions, and to replace that current requirement with a new requirement based on concepts the IASB added to its conceptual framework in 2018. The new requirement would be that the entity has obtained the specific economic benefits or taken the specific action to which the obligating mechanism applies, and as a consequence, will or may have to transfer an economic resource it would not otherwise have had to transfer.
The change in this general requirement would have practical implications for obligations, typically levies, in which a transfer is required only if an entity takes two or more separate actions. The exposure draft proposes to withdraw IFRIC 21, which states that the past event condition for a levy is met only when the entity has taken the final action, the action that triggers the payment of a levy. And it proposes to replace IFRIC 21 with a statement that the past event condition is met as soon as the entity has taken at least one of the required actions and has no practical ability to avoid the remaining actions required to trigger the transfer.
So you can see that provisions for this type of obligation could be recognised earlier under the proposed new requirements than they are recognised at present. This is most easily illustrated with an example, and Stefano has prepared one to show you.
I do have it. Here it is. The facts in this example are that a government charges a levy on companies operating in a specific market. The levy is 1% of revenue the company generates in year X0. However, the levy is charged only on companies that also generate revenue in the market in year X1. Here we have a company that generates revenue evenly throughout year X0, and in year X1 starts to generate revenue on the 3rd of January. And the final relevant fact is that throughout year X0, management judges the company has no practical ability to exit the market before year X1. In this example, the company has to take two separate actions to trigger a levy. It has to generate revenue in year X0, and it also has to start generating revenue in year X1. Currently, under IFRIC 21, a provision would be recognized only when the company takes the action that triggers the levy, that is, when it starts to generate revenue in year X1. In contrast, under the proposed new requirements, the company would accrue the provision over the course of year X0 as it generates the revenue on which the levy will be payable. This is one of the new examples that you'll see in the exposure draft. It is the simplest of 4 levy examples that the IASB proposes to add.
Okay, let's move on now to discuss the second of the 3 sets of proposed amendments, tighter requirements for discount rates used to measure provisions. IAS 37 requires provisions to be discounted to their present value if the effect of the time value of money is material. This is most likely to be the case for large, long-term provisions, typically the asset decommissioning and environmental rehabilitation provisions of energy generation, oil and gas, and mining companies. The first proposal aims to standardise the rates used. The proposal is to require companies to use a risk-free rate. That is one that reflects the time value of money but makes no adjustment for credit risk, otherwise known as non-performance risk. Currently, some companies already use risk-free rates, but others use credit-adjusted rates, so the new requirements would enhance comparability by reducing diversity in practice.
The exposure draft also proposes requirements to disclose the discount rates used and the approach used to determine those rates. The requirement to disclose discount rates would simply bring IAS 37 into line with other IFRS accounting standards. The requirement to disclose the approach used is proposed on the basis that companies could be using various different approaches, and users of financial statements need to understand how the approaches differ in order to compare one company's provisions with another company's.
And finally, moving on to the third and last of the proposed amendments, an explicit requirement on the costs to include in the measure of a provision. This requirement would affect the measurement of provisions that will be settled by providing goods or services. For example, provisions for onerous sales contracts. The amendment stems from an amendment the IASB made to IAS 37 in 2020, and that older amendment clarifies which costs an entity would include in identifying whether a sales contract is onerous. It raised a question as to whether an entity would then use the same costs in measuring the resulting onerous contract provision. The amendment now being proposed simply makes explicit that, yes, the entity would use the same costs. IAS 37 requires a provision to be measured at the best estimate of the expenditure required to settle the present obligation. The exposure draft proposes to add a statement that the expenditure included would be the costs that relate directly to the obligation, which would include both the incremental costs of settling that obligation and an allocation of other costs that relate directly to settling obligations of that type. We don't think this amendment would have significant implications in practice. It is really just making more explicit, and hence readily understood, a requirement that many people already think is implicit in IAS 37.
And that brings us to the end of this webcast. We hope this introduction has helped you understand the proposed amendments and leaves you keen to read the exposure draft in full.
And we look forward to receiving your comments. Thank you for your attention.